Hello and welcome to Bond Street. Our guest today is Somnath Mukherjee. He's CIO at Ask Wealth Advisors. Somnath, hi, thank you so much for joining in. My first question really is on how would you describe the current environment when it comes to investing, especially by the wealthy Indian investors?
Well, the market's growing very fast. In fact, the last 10 years have been extremely positive in that respect. Two things have happened. Wealth creation have gone up in India, partly because of the growth of capital markets that has enabled a significant amount of monetization of operating assets, both by legacy families as well as new age startup entrepreneurs. And secondly, there's been a much higher embracing of risk assets by Indians in general. And we see that in terms of the growth in number of demat accounts. It's sort of grown by 5 or 6 times in the last few years. Ditto in the number of mutual fund folios. That's also grown by 6 or 7 times in the last few years. So that sort of represents the growth in wealth, and hence that kind of then we are part of an ecosystem that enables people with wealth to manage them optimally.
All of these high net worth investors, what are they thinking about debt investing right now?
Debt actually, in all shapes or forms, continues to be the single largest asset class in client portfolios. Obviously, equities has grown significantly over the last decade or so. But if you look at overall savings pool of India, including fixed deposits, which I consider as one of the elements of debt investing, by far it continues to be the largest part in client portfolios. As I said, nobody, even the most wealthy, nobody comes to us to create wealth. They've come, their intent in financial markets is to preserve and optimize the wealth that they have already created. By definition, therefore, by simple precepts of asset allocation, debt will continue being a very, very large part of portfolios.
How are you then looking at the OBPs? Have they changed? Have they changed a lot on ground when it comes to investing within bonds, or do you think it still is about education and some bit about transparency that the street faces?
I think we are at a stage where the market was, the institutional market was, with respect to G-Secs, say in the late 90s, early 2000s, when primary dealers came in. And before that, G-Secs were also not such a transparent market, dominated by brokers on Dalal Street and banks. It did not have the reputation of being very transparent and so on. But late 90s, early 2000s, a whole bunch of primary dealers got licensed, and they kind of created a market. And today, G-Secs are a very large market. Indian G-Sec market is the 3rd largest G-Sec market in Asia. I think we are at the same cusp as far as corporate bonds are concerned, and OBPs have had a significant role in getting us to that stage. Just as the Mutual Fund Sahi Hai campaign by AMFI created the whole movement towards SIPs and in many ways sparked off the tremendous growth of mutual fund AUMs in the last 10, 15 years, I think in bonds, we are right at the cusp of it. We are seeing significant amount of interest. What has helped is equalization of tax regimes across various fixed income products that happened 2 years ago. So whether it's banking deposits or mutual funds or bonds or insurance, everything gets taxed at the same rate. One can argue whether the rate is too high or too low. The fact is it's the same. And that has taken tax arbitrage out of the equation in terms of selection criteria. And that's become a big sort of enabler for growth of the corporate bond market. I think we are right at the cusp, and we'll see a tremendous growth in the next few years.
In the kind of market that we are in right now, what is more attractive as an opportunity, and especially within the fixed income part of it?
See, there is no one spot that one can say is the most attractive opportunity as a bellwether sort of criteria or bellwether decision. There are various things that make sense. Newer categories, newer products are getting created. InvITs have gotten created. REITs have gotten created in the last 4 or 5 years. They have brought in a different dimension to fixed income alternates in the whole equation. We have seen structured credit take off in a significant manner in the last, I would say, 4 or 5 years. Again, a category that was usually the bailiwick of institutional investors, especially foreign institutions. In the last 4 or 5 years, we have seen a significant amount of domestic HNI and as well as in some ways retail interest in that category as well. A lot of it is dependent on risk appetite. A lot of it is dependent on sophistication, experience of the investor. But the sheer variety and eclecticism in product mix today that is available is very, very significantly wide. And hence people can choose. And the level of interest, one of the things about Indian financial markets is that adaptability and adoption are both very high. Anytime a new category comes in, if it's relevant, if it's good, it gets embraced very quickly, irrespective of how complex or non-complex the product is. So I would say that the opportunities are significant, but you do require a significant amount of work, research, evaluation in order to pick a portfolio that is right for you.
Somnath, thank you as always for joining in, and thank you for joining us here at Bond Street.
Thank you.
Appreciate your time.
Thank you.
Thank you.